the crash is ongoing, but you're buying time for GDP growth to come back.
Raoul Pal has warned that governments are trying to keep the oncoming crisis a secret from the public in order to protect their authority. But if you look at the evidence, people should really be waking up.
Our problem is, if you're in debt and you don't have enough income, i.e. your income's not growing enough to service your debts, you get into a problem. So what we've been doing is monetizing those interest payments on the debt, which is basically using a credit card to pay off your credit card, or using your credit card to pay off your mortgage. Okay, that's not sustainable. But what you're hoping is that eventually your income goes up. And there are ways to do that. And the big issue here is demographics.
Let me ask you a very pointed question before we move on. When was the last time real wages went up?
They haven't really risen since about 1972, 1974.
And this is why I think the glide path is going to be gnarly.
According to Raoul, we're currently in a transitional phase of the business cycle, moving from what can be described as an economic summer into fall. This period, which will last for the next 18 months or so, is marked by uncertainty. But right now, there's not much to do except wait. It's like we know a tough time is coming, like bracing for a hit. But as Baron Rothschild is often quoted, buy when there's blood in the streets, even if the blood is your own. Basically, even though we're expecting rough times, there will likely be opportunities hidden in the panic. Right now, a lot of people are freaking out. The optimism and euphoria we saw 6 months ago have shifted into a more cynical, fearful outlook. People are no longer actively seeking opportunities, and that mindset could cause them to miss out on a significant moment. The key here is to understand the bigger picture, the macro market, because we are living in especially volatile times. Look at the global situation. China is locking down again due to its zero COVID policy. There's a war going on in Europe, and we could be on the verge of a global recession. Inflation is still a major issue.
Real wages have not gone up versus prices.
Okay. Meaning
so prices rose more than wages. So if you look at peak, I don't know what peak wages were, but let's say they were 6% last year, year-on-year wage growth, but peak prices were 9%. So people actually got poorer, which is why we've got a recession going on, because everybody lost purchasing power versus just basic goods.
So would you say we are in a recession already?
Yes. Yeah, by every indicator I've got, we're in a recession already. And it will become more abundantly clear. The other thing I think is a point that's also important is we need to think about total aggregate demand within an economy. And who are you giving those increased wages to, right? So yes, you are paying more for scarce labor, certain skill sets, expertise, whatever. But when the labor force participation rate is only 65%, you have to average that over 65% of the economy, not 100%. And that's the function of demographics. So there's a whole bunch of people who are retired whose wages can't go up, which is retirees, which is basically that 35% is that bucket plus people who've opted out. So you actually reduce it by that. And the labor force participation rate is actually a function of the birth deaths rate forward lagged 30 years. So what we know is we know in the future that there's going to be less and less people in the workforce.
While these problems are huge, we can start by trying to grasp the financial structure beneath them, particularly when it comes to debt and how it might implode or be prevented from imploding. And it's not just the US, Europe, Japan, and China are all deeply in debt too. This situation arises because governments and companies borrow money to fund projects now, hoping that increased future productivity will make paying off those debts easier. This strategy often works, but the problem comes when debt grows so large that if something happens to income, paying it back becomes nearly impossible. Most debt is backed by collateral, something of value pledged to secure the loan. If the value of that collateral falls too much, lenders will demand more assets to cover the loan. If this happens on a large scale, as it did during the 2008 financial crisis, it can trigger a chain reaction. Back then, falling house prices in the US reduced the value of the collateral that banks held, causing the entire financial system to freeze up. The same thing almost happened in Europe a few years later, when countries like Greece, Italy, and Spain struggled to pay their debts. When governments can't pay their debts, it puts the whole system at risk. Banks, financial markets, and even basic government functions.
So productivity is going down. The population is shrinking over time. So the answer was debt. The answer all the way through this equation, from these people who were sold the American dream back in the 1950s, the baby boomers. They're listening to Elvis Presley, getting into the Beatles. They're like, let's go, the American dream, I'm going to get rich. But as we pointed out, their wages never went up. But because there were so many of these people, they competed for houses, and houses went up. They invested in the stock market went up. Everything, all assets got more expensive because of their demand. So they did the rational thing, which is I'm just going to borrow money. And the difference between the rise of the assets and their wages is essentially what the debt was. The debt side of the equation is what the government's done too, because GDP is declining. The trend rate of GDP keeps going down.
Since 2008, the solution has often been for central banks to print more money to buy bonds, which helps keep the system from collapsing. This process is known as monetary debasement, where the value of money decreases because there's more of it in circulation. Governments can't let the system collapse because now there's so much leverage, so much borrowing, that if one part fails, the whole system could unravel. We've seen this happen in extreme cases like in Argentina in 2001, where the government couldn't pay its debts and resorted to converting citizens' dollar-based accounts into pesos, wiping out their savings. In less leveraged countries like India, where debt is only about 60% of GDP and economic growth is strong, the risk of a systemic collapse is lower. However, in economies like the US and Europe, where debt levels are much higher and the population is aging, allowing the system to fail would be catastrophic, especially for retirees who rely on their savings. This brings us to today's challenge: inflation. Central banks want to bring down demand for goods and services because inflation erodes the value of money over time. They're doing this by raising interest rates, which makes borrowing more expensive. For example, if your mortgage rate goes up, you're likely to cut back on other spending, like dining out or buying non-essential goods. Rising prices for everyday items, like food, also force people to spend less elsewhere.
And that magic money will solve all of this, and we will all get mutualized because the asset prices will go up and we won't own enough of them and we will get poorer. So that is coming. The commercial real estate, so the quick one is the deposit flight. The Fed needs to cut rates. The yield curve, which is the value of money in the future, of interest rates in the future, has to be higher than currently. It's the opposite right now. So that needs to happen. And then in 2024 and 2025, it'll all be about the commercial real estate, because all of these, like Real Vision has offices in New York for 65 people and 3 people go to the office. The moment we can get out of our lease, we'll get out of our lease, as is everybody. And all of this stuff's going to be empty. So I think that will all end up on the Fed balance sheet. So the banking crisis will continue. It'll make it harder for the average person to get a loan. And the Federal Reserve will see this as the economy goes into recession, and eventually they'll start cutting rates, and eventually the more cowbell comes back. And as I like to say, it is written. We kind of know it. There's no other outcome.
As we go deeper into recession. So if we're already in recession, all that happens, we go deeper into recession. It's already written. We know the outcome. Yeah, I mean, Jesus.
The key issue is supply and demand. If supply is limited, like oil is right now due to the war in Ukraine, prices rise because there isn't enough supply to meet demand. The only way to bring prices down then is to reduce demand. This happens naturally when prices rise, but central banks also try to speed up the process by tightening monetary policy, which slows the economy down. Unfortunately, this often results in job losses and economic pain, but it's seen as necessary to bring inflation under control. We're all feeling the pinch from inflation. Everything from groceries to gasoline is more expensive, and the reality is that we have to endure some economic pain to bring things back into balance. This pain, which includes job losses and reduced spending power, is the price we're collectively paying for the inflation caused by a mix of factors. The pandemic, supply chain issues, underinvestment in key resources, and the transition to green energy, among others. The Federal Reserve has two options when it comes to managing inflation. They can either raise interest rates, which then trickles down to affect mortgages and various other financial products, or they can let the market self-correct. When prices get too high, people stop buying, causing prices to fall back naturally. So whether the Fed steps in or the market sorts itself out, the goal is to cool down inflation. Right now, it's a mix of both. The Federal Reserve is raising rates, but the market is also reacting, and consumers are the ones bearing the burden during this transition.
But meanwhile, the deposits keep leaving the system because the Fed are whistling past the graveyard going, la, 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 I can't hear you. The problem is interest rates are too damn high, which is the same problem I said. They need basically to get back to zero again. And it's leaving the system. So there's two phases of this. One is the banks will start getting worse again. We'll see use the KRE ETF, which is the regional bank ETF. It's easy. You can look at that, get it on Yahoo Finance, wherever. You see the price of it going down. That's telling you it's kicking off again. And the outcome will be to keep bailing out these banks, whether they force them into mergers, which was how the banking crisis in 2008 started. And then eventually it's like, shit, we need to give money and sort this out. So we will see that. We know that the banking system can't go to a full-blown reset because we've already had that. I think it'll bring down one of the big banks before it gets really serious. And which one is that? I don't know. Bank of America? Something like that. Their share price doesn't look great. The structure of it.
From the perspective of someone who closely watches interest rate movements, the bond market usually starts tightening long before the Federal Reserve does. You've probably heard people say, the Fed is behind the curve. This means the bond market has already priced in the fact that interest rates need to rise to curb inflation, while the Fed is playing catch-up. Markets do a good job of anticipating these things. Prices go up until they become unaffordable, and then people stop buying, which pulls prices back down. One big fear, though, is when inflation becomes deeply entrenched, leading to what's called a wage price spiral. This happens when everyone starts asking for pay raises at the same time to keep up with inflation, which then forces prices even higher. This kind of spiral happened in the US during the late 70s and early 80s, when the baby boomer generation all hit their prime spending years at once, driving up demand for houses, cars, and other goods. The baby boomers, around 30 years old back then, were settling down, buying homes, cars, and spending more as they established their lives. On top of that, there were significant oil supply issues, which created a double whammy of demand and supply shocks. This combination led to skyrocketing prices. That was a rare instance, though. In general, as prices rise, the economy tends to slow down, which helps bring inflation under control. It's almost like a self-regulating mechanism. In today's world, many people are carrying a lot of debt, and the population in places like the US and Europe is aging. So when prices rise, especially for retirees who rely on fixed incomes, they can't just go out and earn more money. They simply have to cut back on spending. This reduction in demand over time helps to cool inflation. The bond market, which is essentially just a fancy way of saying interest rates, plays a big role here too. Interest rates determine how expensive it is for people, companies, and governments to borrow money. For example, if your mortgage rate goes up, you'll likely spend less on other things because a bigger chunk of your income is going toward paying off your house. Even if you rent, your landlord might have a mortgage, and if their costs go up, they could pass that expense on to you by raising your rent. This is why so many people are feeling squeezed financially.
You can penalize people who have excess savings versus the people who don't have enough savings. So you can give poorer people a 15% interest rate to lend at, i.e. to get on deposit. Okay, that's interesting. And maybe they can borrow money at one price versus another. You can do a lot of behavioral economics and changing the system. And behavioral economics, everyone's like, well, that's the Chinese government. They've got spy cameras everywhere. I mean, look, the US government knows everything what you do. I mean, every time I come into the country, I just stare at the global entry, recognizes my face. I don't even show my passport to anybody. I'm into the country. I'm then into an Uber. Everyone knows where I'm going. My Apple Maps clocks me. I mean, look, forget about it. All the governments are the same. So I just think, economically speaking, we could do interesting things. We don't have to be so Luddite about how we use fiscal stimulus, and that we can create.
We can create
incentives, good incentives, if dealt with well.
On top of that, there's another tool in the Federal Reserve's arsenal: the balance sheet. Over the past several years, the Fed has been printing money to help offset the economic damage from the pandemic and the extra borrowing it required. When the Fed prints money, they're essentially buying government bonds, which allows the government to borrow more without immediately triggering higher interest rates. But now the Fed is about to shift gears and start doing something called quantitative tightening. That means instead of putting money into the economy, they're going to start pulling it out. Quantitative easing, QE, which they've been doing, is all about injecting money into the economy by buying bonds. Quantitative tightening, QT, on the other hand, is the reverse. They sell the bonds they've been holding, effectively taking money out of the system. The idea is to reduce the amount of money floating around, which makes borrowing more expensive and forces demand lower. Breaking it down simply, when there's lots of money available, banks are more willing to lend, and at lower rates. But when money is tight, banks will charge higher rates or might not lend at all. It's like if a friend asks to borrow money from you. If you've got plenty of spare cash, you might lend it to them with little concern. But if you're short on money yourself, you either won't lend or you'll ask for higher interest to compensate for the risk. Humans by nature tend to want things now rather than later. Leverage lets us borrow against our future income to buy things today. Whether it's a Rolex watch, a new car, or a house, people like to use credit to meet the expectations they have for their future selves. The problem is, if things go wrong, say you lose your job, it becomes hard to pay off that debt. Suddenly, what seemed like manageable payments become overwhelming, and before you know it, the bank comes knocking, asking for the house or car back. In the US, and if you default on your mortgage, you can often just give the house back to the bank and walk away. But in Europe, the debt sticks with you. Even if the bank takes the house, you might still owe them if the house is worth less than what you originally paid for it.
Economic contraction is happening, and the world is slowing down, and money's being taken out of the system. Quantitative tightening, which is the opposite process, and assets fall. And interest rates are going up, so your disposable income's going down because your wages aren't going up enough and the interest rates have gone up more. So it's at that point, you know the outcome is if economic activity is going to slow down, the next year, in a year's time, they're going to be printing money or cutting rates because it's very cyclical for the phenomena of this rolling of this debt.
So it's not exactly looking ideal right now, but if you start preparing early, you may just be able to handle a crisis better. That'll do it for this video, folks. Thanks for watching.